Pullbacks, corrections, and bear markets. Oh my. Thanks for coming back. We've seen markets go up and down for many years. In fact, if you go back to 1950, you can track them and look at all the historical perspective on this. When we see the markets go up and down, it's very, very important to keep this historical perspective. And you say, yeah, David, that sounds good. When my portfolio is going down, I don't care about history. I just care about what my money's doing today. Okay, well, that's fair. But when you think about how you need to react to the news of the market going up or down, it's always the down that people are so focused on, right? When the market's soaring, we're not saying, well, I wonder if I need to adjust my portfolio. Or what if there's something I need to do to my portfolio to make sure it's working correctly? Because our natural reaction to something that's working is to what? Leave it alone, right? Don't mess it up. Don't do anything. Baseball players have all their little rituals, and other sports folks, the athletes, they have all these little rituals when they're winning. They put their socks on a certain way, or don't tie their shoes, or whatever is their lucky charm. Whatever it is, it's not going to interfere with what's going right? So, but the market, there is a historical framework that we have seen markets go up and down, and they behave a certain way. So a couple things just from a terminology standpoint that are very important to keep in mind, and I have no love for the media. I think they create more problems than they solve. And I'm talking about the financial media. Well, the other media is a subject for another program. So when you hear or see either written word, radio interview, or television, and you see whoever it is just freaking out, just melting down. There's, lions, tigers, bears in the streets. Oh my, the world's ending. And then you look a little closer and you realize that the market is down 0.5%. Then we realize that all of that noise is simply to fill space, use ink, fill airtime. So always remember that they've got something to sell, and that is their advertiser's product. They've got to sell the time, and they've got to have you come back or hold your attention either, again, in the paper, on the radio, or on television. So let's get some perspective. If we look at the garden variety typical pullback for the market, 5% or less is generally considered just a pullback. It's not a bear market. It's not a major correction. So if we have a market fall by 4%, okay, and let's just say that for easy math, let's just say that at that given point, whatever it is say the Dow. And let's say the Dow at that moment is 15,000 points. 4% on 15,000 would be 900 points? Can you imagine a 900-point drop? Whether the Dow's at 15 or 17 or 18 or whatever it is, a percentage of 4% translates to a very large point swing. So it's much more important to look at the number of percentage points than it is the points that are actually dropped. And the reason for that is if you look historically, we've come from a period where the stock market has run substantially, and we've had very strong bull markets. We'll get to that in a minute. So a pullback is 5%. In my world, it's expected every day. It's not something to freak out about. It's not something that we should panic or that we should jump up and down and say, oh my gosh, the sky's falling and I've got to go to cash. It's precisely the wrong thing to do when we see a pullback. If anything, maybe we want to go a little bit more into the market. Maybe we want to reallocate. All right, let's heighten the volatility and say that we have what's called a correction. A correction is a drop of 10% or more from a previous market high. So use my same example of 15,000 points on the Dow. That would be a 1,500 point drop. Again, the sky is not falling. There have been many, many corrections in the market. They are actually fairly frequent. Now, when we have a period of kind of a lull, when volatility is lower, it's very, very easy to forget that we have this type of market pullback and corrections from time to time. So, again, not cause to freak out. Next up, the bear market. The bear market is a 20% pullback, reduction, fall from a previous market high point. Now, they sometimes come all at once. We saw back in 1987 I think it was Black Monday it was called, where we had the overall markets fell by 22% in one day. Okay, that's a big deal. That is a big deal. I'm not impervious or numb to market changes and think they're all inconsequential. By the opposite, I think that you have to pay close attention, but it is a normal part of the market cycle. We don't have bull markets forever. Now, bull market, of course, is a rising market from a previous low point. So whenever you have a bear market, and at the end of that bear market, when the things improve and the stocks start climbing again, that's the beginning of another bull market. So you don't have a new bull market until you've had a bear. The bear may be short, but you can't have a new bull until you have a bear. So now, why do they call them bull and bear markets? Well, allegedly, and this is something I don't want to test, when a bear attacks you, it uses its claws to rake you, attack you, knock you down, and use its weight. You know, these things weigh a couple thousand pounds. So hence the dragging, knocking you down the way the market's knocking you down. Bull apparently does just the opposite with its horns. It attacks, it gores, it tries to flip the person off their feet or the animal. So these are the reasons for those names in the market. Now, if I give you some hard numbers here, just for some perspective, if you look at kind of recent history, and I use that word loosely, recent history, part of what has created some of this distortion about point gains versus percentage gains or point losses versus percent losses is that the Dow Jones Industrial Average, which is comprised of 30 mega cap, really large stocks that are really supposed to just be representing different sectors, but it went on this really huge, significant, high-gaining bull market from 1982 to 2000, growing from 777 points up to 11,723 points. So can you see where that distortion comes from? If you had a 50-point or a 100-point drop when the Dow was 777 points, that's obviously much, much more significant percentage-wise than when we're at 11,000 on the Dow or 15 or 16,000 points on the Dow. I mean, 50 or 100 points is nothing. It's just the result of however the trades went for the day. But when you see the last sell-off we had, the major sell-off, that occurred or started in October of 2007, and it ran, of course, till March of 2009, and we saw a drop of 54%. The Dow went from 14,165 down to 6,547 points. So, you know, these things are very significant. Those are large movements. That's not necessarily what we see typically, but they are real. And so let me give you a bold prediction. Pullbacks, corrections, bear markets, and bull markets will occur. And we've had a lot of them over the years. There are some cliches and quotes out there that I think are perfect to kind of sum this up. You can hope for the best, but you've got to plan for the worst. Don't put all your eggs in one basket, and the best way to avoid a punch is to not be standing there. So what do you do about all this? Well, you make plans before it happens. You plan as if next week or next month there'll be a pullback or a correction or even a bear market. And if you do those things, guess what? It'll help you plan stronger.